Here's a truth that will shake your entire trading foundation. 92% of trading failures happen before a trader ever hits the buy or sell button. Not after the trade, not during the trade, but long before the trade even begins. Today, I'm going to show you why risk management isn't just part of trading. It is trading, and why most traders blow up their accounts before price ever has the chance to move against them. Most retail traders believe losses come from bad entries, wrong indicators, or mistimed setups. But that's just the surface illusion. The real destruction comes from the decisions you make in your mind before the chart even loads. Think about it. In what other profession can a single unplanned decision erase months, even years of progress? Humans are built to chase reward, not safety. Our brains want the win, the dopamine, the feeling of being right. But markets don't pay traders who want to be right. Markets pay traders who want to survive. Every instinct that once helped our ancestors hunt now sabotages you the moment you open your trading platform. Risk mismanagement is like an invisible leak draining money from your account. Most traders think risk matters only when price turns against them, but risk is active the moment you even consider taking a trade. Break down the numbers. A trader risking 5% per setup on 10 trades a week is exposing 50% of their account, often on low-quality, emotional decisions. Meanwhile, a disciplined trader risking 1% or less is playing a completely different game. One trader is gambling with survival. The other is engineering longevity. And that's before you factor in spreads, commissions, slippage, overnight volatility, and the mental damage oversized positions create. Stack those together, and poor risk control becomes the fastest way to destroy an account. People think risk management is boring or restrictive, but professional risk control is the opposite. It's aggressive self-protection. Think of a firefighter entering a burning building. They don't rely on hope. They rely on equipment, protocols, an exit plan. Retail traders, they walk into a burning market with no plan, no exit, and no protection, then wonder why they get burned. Real risk management means knowing your max loss before the day even starts, having a predetermined exit, sizing positions so losses barely matter, adjusting stops based on volatility, and evaluating how much exposure you already have across your trades. This isn't passive, it's strategic survival engineering, and when you master it, something powerful happens. Your trading longevity increases, your consistency improves, your accuracy rises, not because your strategy is better, but because your risk discipline allows it to operate. Picture two traders starting with $50,000. One takes 200 trades a year, risks 3% each time, and wins around 55% of the time. The other takes 80 high-quality trades, risks less than 1%, wins 60%, and aims for at least a 2-to-1 reward. The second trader isn't chasing excitement, he's chasing sustainability, and over time, he massively outperforms, with far less emotional damage. Trading platforms today are engineered to trigger impulsive behavior, flashing quotes, fast execution, constant updates. It's not a trading environment, it's a casino wearing a financial costume. To master risk, you must develop risk-first thinking. Before you think about profit, you think about preservation. Before entries, you think about exits. Before setups, you think about consequences. This rewires your relationship with the market from reactive gambler to proactive manager. To implement real risk control, you need structure, fixed maximum daily loss, fixed weekly loss, position sizes capped by volatility, no trading during unpredictable news events, mechanical stop losses, no more than 1% risk per idea, and avoiding stacking correlated trades. When conditions don't meet your criteria, the correct action is no action. And that's not missed opportunity, it's capital conservation. The best traders in the world lose often, but their losses are tiny, irrelevant, forgettable. The worst traders lose small, then slightly bigger, then bigger, until those losses snowball into something catastrophic. Risk management isn't about avoiding losses. It's about ensuring losses never matter. Red days don't hurt you. Undisciplined red days do. Understanding market structure shows you exactly where risk increases. Markets spend long periods in random, unpredictable chop. Professionals reduce exposure during these phases. Retail traders increase it. Professionals scale risk during high-momentum trending periods. Retail traders scale during consolidation. Professionals avoid liquidity traps. Retail traders sprint directly into them. If you don't understand where the danger lies, you can't manage the danger. But here's the beautiful part. Mastering risk in trading strengthens your entire life. You think more clearly. You make better decisions. You become emotionally stable. You stop chasing instant gratification. You start thinking long-term. Discipline in trading becomes discipline in everything. Most traders fall into the same traps: moving stop losses, risking more to make back losses, adding leverage during winning streaks, trading while emotional, using random lot sizes, or letting one trade define an entire month. These are the choices that cause traders to fail before the trade even begins. Every now and then, the market offers a perfect opportunity, a low-risk, high-probability setup with massive reward potential. But you can only capitalize on those opportunities if your account is intact. The real tragedy isn't losing money. It's losing the chance to strike when the market finally gives you clarity. You build your risk muscle with conditioning. Reduce your risk per trade. Increase your required reward-to-risk ratio. Take timeouts after emotional trades. Limit your total trades. Track your risk metrics. Over time, these habits become automatic. Professional traders don't think in days, they think in years. They don't care about one trade, they care about thousands. They don't chase wins, they protect capital. They know the only goal is to stay alive long enough for their edge to play out. Risk management isn't a defensive tool, it's the foundation that allows profits to exist. In a world dominated by high-frequency algorithms and machines that can execute faster than you can blink, there's only one real human edge left: discipline. Algorithms can compute probabilities, but they can't feel danger. They can't stop themselves from overexposing. They can't step back during chaos. Your risk discipline is your advantage. Your restraint is your shield. Your survival is your strategy. Most traders fail before they even place a trade because they ignore the one skill that governs everything. Risk isn't the enemy. Risk is the game.